Thank you so much, everyone, for coming out and joining us here. I'm Logan Nagel with Bullpen, the top provider of contract real estate experts for the commercial real estate industry. I run our research efforts, and I'm thrilled to have this panel of amazing LIHTC experts on this panel. We're looking at demystifying low-income housing tax credit investment, some of the logistics, decision-making, on-the-ground realities, nuts and bolts of actually investing in these assets beyond just how to calculate tax credits, right? So really thrilled to have everyone here. We will be recording this. We'll send it out afterwards to everyone. So if you have to jump off or want to share this with a colleague, you'll be able to do so. I have a fantastic panel here. I have Mark Littenzi, Rick Slagle, and Stefan Cronenberg, and I will hand it over to Stefan to introduce yourself.
Yeah, hey everybody. Like Logan said, Stefan Cronenberg, president of Cronenberg Enterprises. We're a development and advisory business based here in the Washington, D.C. area, helping owners look at parcels and look at them multiple ways, market rate and affordable, as well as finding strategic partners to execute and ultimately produce more housing. So, yep, I'll pitch it to Mark. You want to go?
Yes, Mark Littenzi. I'm a development manager with Brian Wishneff and Associates. We are headquartered in Roanoke, Virginia, and I sit in our Arlington office. We are a tax credit developer and tax credit consulting and syndication firm. And so we work with clients in all 50 states that are working in the federal and state tax credit spaces. That includes everything from new markets, tax credits, historic, renewable energy, brownfields, affordable housing, obviously. And we also do tax credit development ourselves in the Mid-Atlantic, usually spanning the historic, affordable, and new markets areas.
All right. Hello all. This is Rick Slagle. I am president of Aspen Grove Housing Partners. I've been working in the LIHTC field for the past 25 years. Pretty much LIHTC being the focus of what I do. I have one or two market rate deals, a couple historic, but majority of what I've done for the 25 years has all been LIHTC. Majority of my career was actually in investing, but through the 25 years I've done consulting, investing, and now concentrating really on the development side.
Awesome. Very cool. Well, hey, we're going to get started here with the questions. We have a series of questions to get through and some time for Q&As. There should be a Q&A function on Zoom. If anybody here has any questions, either about something we're talking about or something else related to affordable housing investment, just throw it up there. And if we have time, we'll get to it. So first off, we're going to start with a big one, and I know this one could go in a lot of different ways. How do you decide whether to underwrite something as affordable? So, Stefan, how about you start with that one?
Yeah, I could take that. It really depends on kind of what your role is in the industry. I mean, if you're a nonprofit developer, likely looking to produce affordable housing, every option is that producing more affordable housing, but as someone who's also spent a lot of time on the market rate side, a lot of what you're seeing today with what has happened with interest rates and construction costs, market rate projects are getting more challenging to pencil from an economic return perspective. So I'm running into a lot of people who are now asking the question, does this market rate deal make sense? Am I ultimately just doing it for the development fee? And what are my other options? And so, to some extent, if you're trying to do a fee comparison, it's worth looking at, what an affordable housing deal, can get you. So, the standard for the federal program is a 15% development fee. So if you compare that to a market rate deal at 3 to 5%, and obviously it varies from jurisdiction to jurisdiction. Sometimes there's caps depending on what state you're in. In Virginia, you could probably get all the way up to a $5 million fee. You don't always get there. At the end of the day, it's making the sources and uses match, and it's deferring development fee, and it's always a bit of a tug of war trying to make those things match. So there's opportunities out there, and I think that's one way to look at it if you're a market rate developer who still is incentivized, obviously, by an economic return. And then, generally speaking, this nation is in a housing crisis. I think a lot of people should start to look at the affordable housing production space. And hopefully the federal government can continue to expand that program and make it something that, you know, more people can more or less jump in on. And I think we can talk more about it here later in the segment, but we're seeing a lot of that, I think, happening, especially in the 4% credit space, and demand seems to be going through the roof, and what was once not competitive is now competitive. So, you know, that's probably how, you know, I would probably approach that. And it certainly depends on your motivations.
And if you don't mind me, you know, tacking on, I'll just say as a lifelong supporter of affordable housing, so there's that side, but also, you know, to kind of back up what Stefan was saying, you know, the other thing to remember is, yeah, but one thing always cracks me about market rate developers when they want to get into this is they say, you know, what's the return on my capital? Well, you really have no return on your capital because you have no capital in it. I think that is a significant difference between market rate and affordable too, is any pre-development cost or anything like that, you're getting that out at closing, and you really should have those zero capital in the deal. You should be able to get that back and then make fee on top of that. So you are limiting your upside as far as cash flow, but the money up front is, you know, well, it's zero. So it's a big difference between that and market rate.
And so also adding on to that, what Rick and Stefan had mentioned is absolutely true from an economic standpoint. More from a qualitative standpoint, something that I find myself talking to some of our affordable housing clients is the overall application process and jumping through the hoops that you have to go through in order to get your project off the ground. I think from a market rate standpoint, it's sometimes hard for those developers to work themselves into such a knot that allows them to carry out a affordable deal. You know, do they have the staffing that they actually need in order to fill out the applications and vet the consulting clients that they're going to need on the development, and all that kind of stuff needs to be weighed in, because at the end of the day, as with working with any federal incentive program, it comes with strings attached, and the brain trauma that comes with affordable in particular is very real, and it also translates to a longer timeline for development projects sometimes. And you know, is that something that you are willing to sign up for? That's also an important question that should be weighed, especially when it comes to doing affordable developments in states that are not as I'll say efficient and friendly as other states. I think we're going to get into that a little bit later, Logan. Is that right? Which states are ideal? Yeah. So that's also an important part. You know, are you also looking at development in the right state? Affordable housing is incredibly fragmented, and it goes up and down state to state, and so it's not the same across the country.
I think that's really interesting, and I want to follow up on that, just open to everyone here. You talk about that, the brain damage, right, and all the hoops and all that kind of stuff, all the regulations that you have to do, applying the process. Is that the kind of thing that, you know, once you know it, or is it a constantly evolving challenge that you really, really need to stay up on? And then I guess the corollary of that is, if you're a developer, right, and you're doing multifamily and you're considering doing affordable, is it really, really, you know, taking your entire ship and pivoting it? Or is it the kind of thing where you can be like, hey, this is my business, I'm going to go and try affordable now and see if this one works? What level of commitment does that represent?
I'll jump in real fast. So I've done deals in 24 different states. I've worked in, you know, a lot of different localities, and you know, if you're a national developer, it does take a little bit of learning from state to state, and so you can't switch just from the mindset of Virginia straight into Rhode Island. Both rate agencies, by the way, I don't pick on them for any reason, you know, other than they're very different. So you know, what the application process, the timing, what they want to see, how they want to see it, even how they interact with the developers are all very, very different. Now, if you're working in, you know, the tri-state area, you know, DC, Maryland, and Virginia, you know, there's enough overlap. There's enough the same. Things evolve per state kind of slowly. So it's not like if you're working in Virginia, you wake up the next year and all of a sudden you've got a whole new program. It's pretty easy to stay on top of the minor changes from year to year. But state to state, the differences are actually pretty major. So.
And just from personal experience, I often see developers billing themselves as market rate developers or affordable developers. And when they complete one of those projects, the first thing that comes to their mind is doing another one just like it. And so I think it does take some mental finesse to consider something different than what you just did, especially when it's top of mind and you were able to successfully finance it and use certain programs a certain way. And you have relationships, who to ask questions to. All that stuff accrues throughout a project, and I think at least leads our firm into doing what worked well in the past for us. And so it definitely colors our vision in the future as we look at our next project, admittedly.
And just to chime in there on this too, on this piece, I kind of experienced this working for a market rate developer who, actually did own a Section 8, project-based contract. And we were looking to do a phase redevelopment of an existing community without displacing residents. And so the first phase was, essentially capitalized with a Section 221 D4 construction to permanent loan and a land contribution. But then, construction costs went up and interest rates went up. And before we knew it, we had a $20 million equity gap. And so even though it had been 30 years since the company had done a LIHTC deal, we had to quickly get smart. What if we add LIHTC to this? We quickly learned that there's probably nothing better than trying to couple a Section 8 contract with LIHTC. And, before we know it, we were able to make it work again. And, it is a big learning curve for market rate developer initially to try to get in. I mean, there are folks like Rick and others who can obviously help with that. And that's ultimately, what we did when we were at the firm. We brought in a LIHTC consultant and, quickly underwrote it and figured out the timelines. And I mean, I think a large part of it is there's, especially in this case, we were dealing with HUD asset management, trying to get the markup to market rents on a Section 8 contract, predicting or essentially mark them up to what the new construction asset would be from the existing rents, which were much lower. We were dealing with HUD new production to get the Section 221 D4 loan, lined up, and then couple that with the DCHFA and DHCD LIHTC application we had to do. Before you knew it, you're juggling 3 major processes and trying to time them all up accurately. And then you get thrown a curveball, in DC this year. All of a sudden, DHCD came out and said, 4% tax credits are competitive, and you need to hit these certain application windows. And so you're chasing yourself in circles to some extent, trying to make all of these timelines match up. But at the end of the day, these are really powerful programs, and they can make a really big difference.
As Stefan was saying all that, one other thing that came to mind is site control is a really big deal when it comes to LIHTC versus market rate projects. With affordable housing, when you're going through the application process, you have to demonstrate adequate site control. And if you're doing it in such a state that only has the application window open once a year, you have to tie up that property for long enough to give you some decent runway to be able to make it through that process and a resolution and ultimately a closing before you're able to technically close on that property sometimes. And so that's just one other consideration and usually an upfront one to consider when thinking about which direction to go.
Yeah, not to beat the horse, but I'd say that the LIHTC, big difference between our program and the LIHTC world is it's a very set amount of financing for the nation that is always oversubscribed. So each state is it's a beauty contest. We even now in 4%, as Stefan said, versus 9%, it's a beauty contest, and they can decide who gets these credits and who doesn't. So you could be go through all the process, be left holding the bag. So they want to make sure that you have site control. You have the right property, what you're doing, you've got the right people on your team that understands this program and all the hoops, and and all the various ways you can get yourself in trouble. And if they sense that you don't have everything just right, those credits are going somewhere else, and you're just not getting them. There's not just a big market out there that says, hey, we'll just print some more. It's finite, and that's it. So.
Well, I think that's a great transition to our next question. Geographic areas that work particularly well for LIHTC. And I think, Rick, you have some thoughts on that one.
Yeah, I'd say, it kind of starts a little bit with, what can you buy? I mean, if you're looking downtown Philadelphia, at some, fairly expensive property on, right in city center, it's going to be hard to make a LIHTC deal out of that because the per unit cost is just going to be out the roof. But if you're out in, one of the suburb counties of Philadelphia, you can start to make that work. So it first starts with kind of, what are we talking about for per unit cost of land and or unit? So it really kind of starts there. You also might have some city pressures of, sometimes you get bonus density if you do a LIHTC deal. You might look at something like that, but really I think it's dictated by acquisition cost more than anything else. You also have certain areas that might have more NIMBYism, not my backyardism. I'd say just pick on an area that's fantastic. Northern Virginia is traditionally fantastic and very, very supportive of affordable housing. You can't always say that about all your localities. There's some other counties in I grew up in Virginia, so I'll pick on that state again. That it's hard to get affordable housing done because you're going to get opposition right off the bat. So kind of look at that. Talk to your local officials. See if they're supportive. And if you start to get a little bit of support there, I think that's a place you really, really start looking at pretty heavily. But I think those two things really start to dictate. Can I make this work from there? So.
Right. And kind of adding on to that, one recent instance where we saw very clearly a communications from a locality that affordable housing wasn't welcomed was in West Virginia, where we were actually considering a project in a downtown area. And I think their thinking was that so much of their housing in their downtown is naturally affordable anyway, that they really need to promote and bolster their market rate sector, and they wanted new market rate housing in particular, and they're willing to come to the table and support that kind of project to make it happen where it hadn't happened before. And so having those conversations with localities and housing authorities is paramount to getting started on the right foot and not wasting any time, frankly, because you can spin up your wheels only to find out after the fact that there's certain opposition in a community that will instantly kill your deal, no matter what you do. And so that, and one other thing comes to mind when it comes to picking geographies is certain areas, certain states champion affordable housing and put money behind it more than others. And so, do you want to go to a state that has a lot of funding sources, a lot of programs to help make projects happen, or do you want to go to a state that is more so just relying on those federal incentives and not really providing any soft money, any pre-development loans to cover very, very upfront consulting costs? Those are all very variable from state to state, and so they're not all equal by any means.
So, I know if you're a developer, right, even for market rate, it's hard enough if you're growing, starting out, scaling to cross markets, to cross different geographies. Are there extra difficulties if you're, say, a LIHTC developer based in Chicago, and now you want to do a property in Colorado, right? And you're not already a huge tax credit developer? Is it even harder to get kind of in the ear of some of the people that matter there? Or does it make sense to start close to home?
It makes sense to start close to home. I was going to jump in. It is. Certain states want you to have experience, and sometimes that's even state experience. So They definitely like to know that you know their program, their stuff. There's even state certifications for architects and your team players to make sure that you know exactly what that agency wants versus any other agency. Now I will say, experience in any state helps you in the other state, so they're not going to say no to you. That said, it does help. Show up to the state conferences. Go talk to them. Make meetings with them. I also want to say these agency people aren't scary people. They're doing this. It's a job, sure, but we all do also something that we care about, and they definitely across the country. I see them really caring about their job, and they want to help you make affordable housing. So they are more than happy to talk to you. Just be patient. Give them time, but when you get them, they will be more than happy to help you. So.
Yeah, and I think what I'm noticing is Rick mentioned that Virginia, especially Northern Virginia, is very open to affordable housing development. And it's interesting, some of the things that I've run into trying to get certain deals off the ground is they're all incredibly supportive of it. But there's so many developers in this area who are all offering up affordable housing projects that, they want to support you, but there's only so many funds to go around. So it becomes competitive. And that really ultimately becomes a challenge. If you're entering a market where people have been entrenched for a really long time, and they may have the housing resources. I mean, something that we've seen ever since the middle of last year, when the IRS clarified that COVID relief funds could be used to help the production of affordable housing, whether that's investing in land or other. You saw immediately in the Northern Virginia area several projects getting approved with COVID relief funds, where maybe a local housing authority used the funds to purchase the land from the existing landowner, and then contributed the land at a $1 ground lease a year back into the deal to make things work. But developers hear about this quickly, and then before you know it, there's a long line to get your foot in the door. I mean, I was looking at a deal that was an existing office property had leases terminating within 2 years, and it's one of those 15% of office floor plates that actually lends itself to a residential conversion, and so there were significant cost saving opportunities in terms of doing an adaptive reuse application, and it had some infill potential, and there was an existing parking deck, and I wanted to approach the locality and make the argument that, look, we can produce new housing here for $50,000 a unit in gap financing. And the average gap financing in Virginia last year for a 4% credit deal was in the $125,000 a unit range. So from a capital efficiency standpoint, this was incredibly attractive. But at the end of the day, if you're not getting in at the right time, and in this case, the existing landowner was trying to sell the asset, it came down to really matching up the timing. And because the existing landowner, was marketing the asset as an industrial play, and they wanted to get it off their hands with increasing interest rates, we couldn't get the county and everyone to act quickly enough. So there's a lot of challenges trying to get all of the different parties on the same page, for sure.
And I saw just in the Q&A, someone asked the question about what it costs to get help with LIHTC applications, and is there any kind of rule of thumb as far as sizing? And somehow we actually glossed over that, because that's actually a pretty important consideration when it comes to thinking about LIHTC. And so, Rick, would you want to take that one?
Sure, I can. It does vary a little from state to state. I'd say that oddly enough, some states just have a lot more consultants doing things like this than other states. It a little bit depends on the state, but I'd say the sweet spot of just to answer the question, what I see is somewhere in the $100,000 give or take range, to really kind of put it together from nuts to bolts, because it's an involved thing. There's a lot to it, and you do have to have your certain studies. You're gonna have to market study, appraisal, include your environmental. You probably have to get a little bit of attorneys and accountants involved, not a lot, but with some states the application process is it's a lot. It's very, very involved. It's very thick. It's a lot. It's just a lot of time. I don't know any consultant also that can do more than 3 at any one time. Maybe there's something really processed out, but to really make one person do it right, you do more than that. It's an insane amount of work, especially since you have these really tight deadlines. You're trying to do them all at one time, so it's not a cheap proposition. But it's you go through it, you get the right consultants. Clearly, they know what they're doing. They can walk you through it and say, up front, this is why I think this will score well and win, or you don't really have a shot. Just walk on. That you should probably get for free, give or take. But I'd say some I see some states go even higher than 100,000. Like I've seen as high as 150. I see some as low as 50, but I'd say 100,000 is probably a sweet spot. So.
And then what about in terms of project size? Maybe you go by unit, because dollar size is very hard to make apples to apples.
Yeah, to really make a deal worthwhile and efficient, you're really going to have to be hitting, I would say 50 units. You might be a little smaller, but it's really hard to make it smaller and efficient and worth the time and the brain damage to really get it done. I do think in terms of investment dollars, because that is the side of the business I was on for so long, you really can't get an investor interested in much less than 5 million, sometimes as low as 3, but if you're generating tax credits lower than that, you're really not a deal. You just gotta let that one go. So it's really, it's size, 50 units to make it efficient, about 5 million and up for investment dollars. And then I think you've got something that you can work with.
So we're getting a ton of really good questions right now, and I want to make sure we have time to kind of ask another big question here, which is, how do you really get started? What are the resources? What are the first steps that you should take if you want to go down the LIHTC road? What are the first steps you got to take there?
Well, the first thing that comes to my mind, at least, is what's called the QAP, which each state creates, and it's essentially their Bible of how they administer their LIHTC program. And if you want to go from 0 to 1 very quickly in LIHTC, read through that and don't fall asleep. That is a important document that is put out each year, talking about the application process, the details, the really nitty-gritty stuff that a developer has to follow, and that will kind of establish some parameters for a typical project. And so that's a number one place to start.
And make sure you're looking at the latest one. Little pro tip there. Yeah, because they update them from year to year. I'll just add in there. Obviously Google searches and Novogradac, and just generally understanding the high level of the federal program, how to underwrite it. The 4% credits giving you something along the lines of 30% present value. Understanding really the big movers, the 30% basis boost in difficult to development areas or qualified census tracts that HUD designates. All of that is obviously available online as kind of the basics around the federal program. But it does get challenging because every local jurisdiction, every state has its own pots of money, and they're more or less kind of all over the place. They can be, county by county. They can overlap with state. You can have multiple housing authorities. There's just so many pots of money. There could be housing production trust funds. A lot of what I'm starting to see in the DC area is, localities really stepping up their tax rates and funding trust funds. I mean, I think Washington, DC is one of the states that's, or, not technically a state, but is leading the country in terms of its contributions towards its housing trust fund. I mean, this year alone, the mayor put forth $450 million into the housing trust fund. And the prior few years, she was somewhere around the $200 million mark. Compare that to Fairfax County, which is a county in Northern Virginia outside of DC, where they doubled their commitment to the housing trust fund, but it went from 15 to 30 million. So it's unbelievable. There's, you really just have to be in touch with what things are moving, what the politicians are doing, where the support is, what the different programs are. And at the end of the day, that's a construction subsidy. Then there's the operating subsidies, the vouchers. Maybe those vouchers will allow you to charge higher rents than the LIHTC max, and therefore underwrite a larger loan to cost, and therefore close the funding gap in that manner. So there's just so many different pots and resources that you can go research, and unfortunately there's no one place that has it all, which to some extent sounds like a business idea if someone wants to corral all that information. But yeah, so I don't know, Rick, if maybe this already exists, but
I saw someone start a company doing that. I actually don't know where it went, but
okay. Must have been too difficult. That's why.
That's ambitious because there's so many and it changes so quickly. But yeah, you just really got to start diving into both your guys' points. It's UAP, talking to the agency, and really kind of just nosing around and seeing what's out there.
So we got a question, is there a way to, if you're starting out, right, and you want to get into this business as a newer developer, is there an opportunity to JV or other ways to get into doing this kind of experience before you go and take the full plunge and potentially lose out on your application?
Yes. Yeah. Always, not every company is going to want to JV, but I will say that I have a couple JVs, and and they work. It's you got to just make sure clearly, like every other relationship you're in, make sure that the expectations and the responsibilities are very well laid out. But getting in with someone that really kind of knows the pitfalls, because there are a lot of ways, unfortunately, to get yourself in trouble in the LIHTC and affordable world. So someone that really knows the players and can help you start to get in, it can be very valuable, and it's definitely something that people out there are doing. So
another idea for a small developer when it comes to JVing is actually doing so with a existing property owner, whether that being an existing apartment complex that could be rehabbed into a LIHTC, or just a piece of dirt that you could do a new construction. JVing with someone like that is very conducive to putting the initial pieces of a deal together, and it crosses off an important piece of the puzzle because of what they're bringing to the table.
Very cool. Well, in the last 10 minutes here, I'd like to take some time and explore some more of these questions that we got. And one of the ones that I wanted to touch base on was, we had a mention about LIHTC leading to no upfront capital invested. Can somebody clarify exactly how that works?
I'm sorry, I said again. I'm sorry.
Yeah, so. We have a question that earlier it was mentioned that LIHTC can lead to lower or no upfront capital requirement. Just some clarification on that one.
Yeah, sorry, I get it. Yeah, so the LIHTC program really is designed to reimburse any of your upfront pre-development costs. So you're not looking at, like, you do your market study, you do your appraisal, you even pay your consultants, like someone doing the application fee. Generally speaking, in almost every state, those are all going to be reimbursable at closing. So you just make sure you keep record of them. But the idea is that you're not putting your own money in these deals and getting any kind of return back out of it. Now, the reason for doing this, clearly the government wants to create affordable housing, but the incentive for the developer really is the developer fee. And if you have to put your own money in, it's not quite the same as getting your fee out. So they're really trying to incentivize that by saying this is what you're getting. This is the financial incentive. So unless you do something really odd, or you just document it poorly, or you're not paying attention, almost every cost that you put in a pre-development cost is reimbursable at closing, and then frankly goes into tax credit basis that generates more credits. So they want you to do that too, because that's what's really generating the credits that's funding the program to begin with. So.
And another way to think about that, because I saw someone else ask the question related to that, is with a market rate deal, you're obviously having an expectation of cash flows into the future each year. And with affordable housing, you could imagine that those are in essence kind of being front loaded such that there is no real cash flow in those out years. You're getting your profit up front.
Yeah, and most of the time, the way these deals are sized is, to make the capital stack work. You're deferring development fees. You have soft loans, all of which are cash flow loans. They eat up, and they get sized to about 12 years of operations, something along those lines, so that by year 15, hopefully you've paid them all back. Which, in year 15 is always an interesting opportunity to, buy out tax credit investors and other things that could actually end up creating value and some kind of economic return. But obviously that's quite a ways down the road. And some of these projects, and just also to say that the federal program was established so that the GP was only putting up 0.01% of the capital, and so that's what they want you to follow, and maybe you're deferring half your development fee to make the rest work, but that's generally the footprint of it.
Yeah, that's actually a good point. Just just make sure that one point's clear. That you are holding these for 15 years at a minimum. It's really hard to sell a LIHTC deal that you're the general partner in before that year 15. So that's the other thing. It's like this is not a situation where you can invest money in and expect in 5 years to cash that back out. So that's the other reason why they don't expect you to have money in it, because you're holding it for 15 years. So.
How about macro trends, right, and interest rates? How are those affecting the LIHTC landscape today?
It's, I actually was looking at this, and we faced this, unfortunately. I mean, just like everybody else did. One of the deals we essentially just increase in interest rates from, take a Section 221 D4 construction to perm loan in the case that we were doing, and that rate was around 3% about a year and a half ago. Now that rate is at 6%. We lost 15% of the capital stack and funding. I mean, in this case, it was 15 million just in loan sizing that got reduced. And so now we have to make up 15% of the capital stack, which normally is the gap you're trying to solve for, that a jurisdiction would potentially fund. And even if they did fund 15%, that's, pretty generous and a big check size. So it really was a massive impact. The only thing that we're somewhat hoping for now is, given the inflation last year, maybe rents will get adjusted upwards. HUD will issue those, I think, in the coming months. Maybe to offset some of those interest rate increases, but it's a real challenge, some of those macro items at the moment. I mean, unlike construction costs, which when construction costs increase, so does your LIHTC equity and some of the funding. It's not one for one, but maybe you're getting 40 cents on the dollar or something like that. So you're somewhat protected in that space. But really, Rick, unless differently, there's nothing in the LIHTC formula that will help you offset the increased interest rates unless they start messing with the applicable federal rate. So it's a challenge.
Unfortunately, nothing right now. I mean, states have some ability to give basis boost if they want to, but again, they're giving away limited resources. So there's definitely a pressure to not do anything like that, and really just hopefully find some soft money to squeeze. I will say, I think Stefan, you said this earlier, there's a lot of soft money in the market right now from federal government, more than definitely in past years, mainly from things like ARPA and things like that have been repurposed for affordable housing. But those are going to start to run out soon, and we're still going to be stuck with high interest rates and high construction costs. So it's going to be challenging.
Yeah, putting all those pieces together, I think it's in this very moment, it's especially a difficult time because on every front, it seems like things are less than ideal. On the acquisition side, for example, you still have sellers who have their 2021 hats on, and they think that their properties are worth more than they are. Interest rates moved against us and quickly, and that just really hasn't seeped in fully yet. And so and then construction costs are continuing to be high. And I think, in an economics textbook, all those things can't really, they shouldn't really happen all at the same time. But at least the transition periods, they are. And so maybe in the near future, you'll get a little bit of relief on the construction side, a little bit of relief on the acquisition side. But especially right now, with rates having moved higher so quickly, it's especially a challenging time.
So there's this 15-year holding period, right? What happens at the end of that? What's the strategy? What are your options? Can you re-syndicate tax credits? What happens at that point in time?
Yeah, I'd say, the most states, there's 15-year hold for as a minimum. Most states, make you sign a longer use restriction. So technically speaking, you're looking at 30 years, 40, 50 years, sometimes even up to 99 years, depending on the state. So the expectation always is at the end of the 15, you're going to just re-up the credits and do all over again. You're going to buy the investor out. You're going to do a bond deal. You're going to do a full rehab on the property, get it ready for the next 15 years of more affordability, and just do that all over again. Get more developer fee, and keep on moving, and just keep doing that. Frankly, and that's frankly, the program has been designed to incentivize you to do that. There are ways out of that affordability, but really, the encouragement is to do just to keep on redoing it. So.
And I think the key point there is you have to spend dollars again to get additional credits. You have to do another renovation. You can't just sign a piece of paper and get new LIHTC credits.
Thank you. Yep, right on.
So we had a couple of references to 9% and 4% tax credits, and without getting into the nitty gritty of all that, just in a nutshell, the difference there, and then in particular, the competitive difference of actually getting those tax credits. What's the story there?
In Virginia, I mentioned this deal earlier, where we were trying to size to a $50,000 gap financing. One of the strategies there was to for the infill development piece, which would have been about 150 units, was to essentially create a condo structure for that building, parse out the 4% and the 9% credit, make them work together. Some jurisdictions actually have limits too, on the absolute dollars as it relates to your 9% credit. But, at the end of the day, the 9% credits are competitive, and you have to hit a very high LIHTC score. I think every state has its kind of own special scoring system. In Virginia, you have an Excel-based application you can fill out, and there's all kinds of economic points that you can get. There's being soft points, so to speak, for being a nonprofit developer, for targeting lower income area median income renters, all kinds of things, right? All of these things kind of end up calculating a score. How much funding are you requesting is actually quite interesting. A lot of the 9% applications, even though you could request, a very high equity amount, a lot of times it's part of the calculus and the score that if you artificially cap how much credits you're actually asking for, it's going to increase your score significantly. And I think what you're seeing in Virginia, it's incredibly competitive. I mean, there's multiple types of pools that you can apply for. There's the nonprofit pool, the new construction pool. And, I think it was the new construction pool where it's just the number one project among 10 others that had the highest scores, the one that got selected. So, and if you don't get selected, then you're waiting a whole nother year. So it's very competitive, and usually the 4% aren't, but, with where things are going and the fact that, states are running into tax exempt bond issuing caps, there's so much demand for these projects. And if with every 4% deal, there's the state has to issue tax exempt bonds, and there's only so many dollars that they can allocate in an annual budget towards that as part of the state budget. And now there's so much demand where even that's getting competitive. And so it's interesting because Congress has the ability to kind of reduce something called the 50% test, which is your bonds that get issued, the tax exempt bonds in a 4% deal, essentially have to be 50% of your eligible basis. So if the Congress were to lower that 50% test down to 25%, it would essentially double the amount of volume that could be done, in all of the states. And it's something that's been, I think, on the table for quite some time, and unfortunately was pushed again when Congress voted on the omnibus bill at the end of last year. So it's something I think that a lot of folks are keeping an eye on at the moment to make sure, or at the end of the day, so that the 4% credits don't have to be competitive, right? So
that would be the single biggest change, I think, to the program right now, the most beneficial, and something that everyone on this call should write your congressman about, because that would be huge. That'd be huge, and it will cost the government not a penny. Actually, would help them. So.
Well, hey, we're at time here. Last question is a really quick one. After reviewing a qualified allocation plan, where should you look? I think Novogradac is a great source for that, the advisory firm. If there's others, feel free to chime in. But I think this has been a fantastic webinar. I thank everybody for joining us here. We will be sending this out via email, the recording here in the next week or two to everyone if you had to jump off or you came on late. So thanks again to all of our attendees and our panelists, and have a great rest of your day. Thanks, everyone.
Yep.
Thanks,
Bye, guys.
Logan.
Thank you.